You can use stops and limits to add discipline to your trading and remove the temptation to make emotional decisions. A stop loss is an instruction to close your position automatically when a certain price point is reached. This price point would be less favorable than the current market price. This helps to minimize your risk and, in some cases, lock in a running profit. The three main stop types are basic, guaranteed, and trailing stops. The most widely used is a basic stop-loss order. This closes out a trade when a specified loss is reached. For example, let's say you open a long position for £100 a point on shares of ABC plc. The shares are priced at 37 pence, and you put a stop loss at 32 pence. Instead of rising as you'd hoped, the shares fall to 27 pence, triggering your stop loss and closing your position. That drop of 5 points means you've lost £500, but without your stop loss, you'd be looking at a cost of more than £1,000. However, it's worth noting that stops don't always close your position at exactly the level you specified. The market may gap, which means it jumps from one price to another with no market activity in between. There's also the chance of slippage, which can occur during periods of higher volatility, making an order at a specified price, like your stop loss, impossible to execute. You can place a guaranteed stop loss order to ensure your stop is executed exactly where specified. This works in the same way as a standard stop, except it'll always be filled at exactly the level you set, no matter where the gapping or slippage occurs. It's good to note that a fee is payable if your guaranteed stop is triggered. IG also offers something called a trailing stop. This is a special type of stop loss that not only caps losses, but also helps protect any profits you make. Suppose you decide to go short dollar-yen at 117.6. You set a trading stop 30 points away at 117.9, choosing a step size of 10 points. The price drops to 117.1 and your stop loss has followed it. It's now at 117.4. However, now the market trend reverses and the price rises to 117.5. Your stop, however, remains at 117.4. So, your position is closed as the price passes through this level. That stop has protected a profit of 20 points for you. However, it's worth noting that if the market's upward movement turns out to be temporary, you may have missed out on an opportunity for greater profit. You can also use limits in your trading. A limit order is an instruction to close a trade at your chosen profit target. Say you have a long position open on XYZ shares. The current market price is $200. You want to close your position if the market price reaches $250. So, you set a limit order. The market moves from $200 to $255, triggering your limit order and closing your position at $250. There's no guarantee that the stock will reach your set price, but by placing a limit order, you know that your position will be closed out without you needing to constantly monitor the market level. You can find out more about stops and limits on our website.